Let's dive straight into the data. Today we're running a forensic financial analysis on Sadot Group Inc., ticker symbol SDOT. So, what exactly is Sadot Group? They operate in global agriculture, trading, and food service. Now, historically, they've been involved in grain and international commodity markets, but what they're actually trying to do right now is build a vertically integrated food and ag platform. And theoretically, that's a fascinating opportunity. Global food demand is massive, it's structural, and it's incredibly defensive. I mean, no matter what the economy is doing, the world still needs to eat, right? If a company can capture margins across multiple steps of that supply chain, the compounding value is just tremendous. But, and this is a big but, the actual quality of the underlying business matters way more than just the size of the addressable market. A great market simply cannot save a flawed balance sheet. Which brings us to the stark reality of this particular stock. Based on the latest market data, we're slapping SDOT firmly on our high-risk speculative watch list. And you really have to notice the crazy discrepancy here. We've got a share price sitting right around $22.95. To the casual observer, a stock with a $22 handle looks pretty standard, right? Maybe an established mid-cap company. But it is paired with an extraordinarily tiny market cap of only about $13 million. That combination is just bizarre. Because there are so few shares outstanding, the entire company is valued at less than a single luxury penthouse in Manhattan. This microscopic valuation makes this equity exceptionally speculative and totally primes it for extreme, unpredictable movements. The absolute core of the problem here lies in their financial condition. If we dig into their 2025 10K, Sadot's financial position is frankly deteriorating drastically. They reported stockholders' equity of negative $54.7 million at the end of December 2025. Just to be crystal clear on what that means, negative equity happens when a company's total liabilities drastically outweigh their total assets. They literally owe significantly more than they own. That's a massive glaring red flag. And this isn't just some accounting quirk either. This severe negative equity directly triggered a notice from Nasdaq stating that Sadot no longer met the minimum equity requirement for continued listing. So you absolutely cannot treat this like a normal, profitable small cap stock. It is currently fighting for its baseline survival as a publicly traded entity. The results for the quarter ending March 2026 give us yet another massive warning sign. Sadot reported a net loss of roughly $4.87 million for Q1 2026. Now, to put that into perspective, in the exact same quarter the prior year, they actually posted a net income of about $820,000. That is a brutal and incredibly rapid deterioration in just 12 months. When you're a microcap company, cash burn of this magnitude isn't just a hurdle, it's an existential threat. The fundamental question isn't simply can they grow top-line revenue. The real test is whether they can actually convert those operations into sustainable free cash flow without constantly begging for outside financing just to keep the lights on. And right now, they just haven't demonstrated that. The immediate flashing red danger, however, is liquidity. As of March 31st, 2026, Sadot reported holding merely $679,000 in cash. And remember, that includes restricted cash, meaning these are funds they can't even freely use for daily operations because they're tied up as collateral. Think about the scale of that for a second. For a global commodity business, that liquidity buffer is practically non-existent. Commodity operations require massive working capital. You've got to finance sitting inventory, float receivables, pay for international shipping, and handle huge supplier payments across borders. A company could literally have a multi-million-dollar revenue opportunity sitting right in front of them, but with inadequate cash like this, they simply can't execute. They could destroy shareholder value in a matter of months just trying to tread water. Which leads us to arguably one of the most pressing external risks on the entire board. In May 2026, Nasdaq formally notified Sadot they were non-compliant with the minimum stockholders' equity requirement. Because they didn't qualify under alternative market value or profitability standards, they're now facing an absolute gauntlet of consequences. We're talking continued listing uncertainty, drastically reduced investor confidence, and potential forced selling. If you're an institutional investor or running a mutual fund, you usually have strict mandates that prevent you from holding delisted or pink sheet stocks. That forces you to liquidate your position regardless of the price. This kind of situation drives up financing costs, skyrockets volatility, and raises the ugly specter of a reverse split. For a microcap, running this gauntlet can absolutely crush the stock. So how in the world do we explain the wild price action we've been seeing? Well, the math here is pretty staggering. In a recent session, we saw over 26 million shares of intraday volume. But according to their 10K from April 2026, Sadot reported only 1.84 million common shares actually outstanding. Let that sink in. When you have 26 million shares trading hands in a single day, but only 1.84 million shares actually exist, it means the entire ownership of the company is effectively turning over more than a dozen times in a single day. You get this incredibly dangerous equation, exceptionally low float paired with a sudden rush of massive demand. Because there simply isn't enough supply to go around, relatively modest changes in market interest can trigger explosive, violent price movements up or down. And those violent swings look exactly like this. The extreme volume created a scenario where the previous close was around $13.18, but intraday, it rocketed to a high of $30.67 before plummeting right back down to a low of $14.10. The crucial point you have to understand here is that this is not investing. This is a game of musical chairs, driven entirely by trader psychology. This is a microcap momentum event largely dominated by algorithmic traders and day traders who are just exploiting the low supply. Now, sure, it creates a massive opportunity to generate huge short-term returns if you time the momentum perfectly, but the danger is equally severe for retail investors. A 50 to 80% decline can wipe you out in an instant when the music stops and the volume dries up. When a company's financial mechanics are this detached from reality, trying to analyze it with your standard investing playbook is just going to fail. Traditional valuation metrics are effectively useless here. Because the company is heavily loss-making and has a severely impaired equity position, things like price-to-earnings and price-to-book ratios mean absolutely nothing. I mean, you can't calculate a multiple on earnings or book value that are deep in the negative. The free cash flow yield is potentially negative too, meaning they are burning cash, not generating it. And if you try to build a traditional discounted cash flow model, forget it. The DCF is going to be so hypersensitive to your assumptions about their basic survival that the output is fundamentally useless. We really have to look at this purely as a distressed special situation and a microcap turnaround. To put all of this into proper context, we really need to contrast this against the rest of the sector. You absolutely cannot view this through the same lens as blue-chip agriculture stocks like Archer Daniels Midland, Bunge, Tyson Foods, or General Mills. Those are massive, entrenched businesses. They have established financial profiles, fortified balance sheets, and global operating platforms that can easily weather economic storms. This company sits in a completely different universe. It is a high-risk microcap fighting tooth and nail for survival. Now, the upside could theoretically be substantially larger than those stable giants on a percentage basis, but the probability distribution of outcomes is infinitely wider. We are talking about a range stretching from multi-bagger returns all the way down to absolute zero. Let's break down the two sides of the trade here, starting with the bear case, which, frankly, is incredibly easy to construct. The fundamentals are flashing bright red. You've got massive negative equity, widening quarterly losses, and extremely limited operating cash of under $1 million. Add to that the severe financing risks and those looming Nasdaq compliance issues hanging right over management's head. And on top of all these internal corporate issues, you still have to deal with the inherent, unavoidable vulnerabilities of an agricultural commodity business. We're talking exposure to shifting weather patterns, unpredictable crop yields, sudden geopolitical events, supply chain disruptions, and crazy currency movements. For a company with no cash buffer, literally just one bad drought or port strike could be a fatal blow. But out of all the bearish elements, this specific risk is the silent killer of microcap portfolios: dilution. Look, when a distressed microcap with negative equity and basically no cash needs working capital to survive, traditional banks usually just say no. So raising capital by issuing new shares to the market becomes a very realistic, sometimes inevitable possibility. If those new shares are issued at depressed prices, existing shareholders suffer brutal dilution. This is exactly why looking at the nominal share price of $20-something tells you almost nothing. You absolutely must calculate the fully diluted market cap. You have to factor in warrants and convertible securities, which are essentially IOUs that can be turned into new shares at any moment, to understand your true exposure. If they have to print millions of new shares just to survive, your slice of the pie shrinks to absolutely nothing. Okay, but let's pivot to the legitimate bull case, because despite all the red flags, it does exist, and the upside is definitely tantalizing. First off, global population growth and food consumption create enormous structural long-term demand. Second, commodity trading can be highly scalable. If management can generate significant volume while strictly controlling their risk, even tiny margins can produce highly meaningful operating profits. But the real driver here is the massive microcap asymmetry. Because the equity market cap is so extraordinarily tiny at just $13 million, the leverage to the upside is explosive. Even a modest, sustainable $5 million improvement in annual net income would fundamentally transform the valuation. The market would instantly reprice the stock, creating the kind of multi-bagger returns that microcap investors absolutely dream of. So what is the exact path management must take to realize that massive theoretical upside? Well, I would need to see 5 specific sequential things happen. Step 1, positive operating cash flow. And I don't mean adjusted EBITDA or optimistic forward projections. I mean actual cash generated from selling goods. Step 2, they must aggressively repair the balance sheet and address that massive negative equity. Step 3, establish sustainable profitability where gross profit actually trickles all the way down to real free cash flow. Step 4, they must avoid destructive dilution. If they do need to raise capital, they have to find creative financing that doesn't just wipe out the common shareholders. And finally, step 5, a clean, formalized resolution to the Nasdaq compliance overhang to restore some level of institutional trust. If we distill this complex analysis down into a scenario matrix, we can really visualize the sheer breadth of outcomes here. At the absolute bottom, the bear scenario of ongoing losses and dilution leads to severe downside, potentially a total wipeout. In the middle, a base case where operations simply stabilize offers a significant recovery from these current distress levels. And at the very top, the extreme bull case, a major operational turnaround that begins attracting serious institutional interest, offers massive multi-bagger potential. The analytical problem here isn't that the upside doesn't exist, it's that assigning a realistic probability to that extreme bull case requires a monumental leap of faith based on their current cash position. The gulf between a total wipeout and generational wealth is incredibly wide. Ultimately, the analytical verdict here is basically binary. This is absolutely not a conventional buy and hold investment right now. Yes, it operates in an attractive, essential long-term industry, but its financial structure is entirely distressed. Because of that, the single most important metric to watch over the next few quarters is not top-line revenue, it is cash flow and their ability to repair the capital structure. Keep in mind, this company does not currently pay a cash dividend, meaning there is zero income component paying you while you wait for a turnaround to materialize. The clock is ticking loudly, and survival hinges entirely on cold, hard cash. So the crucial takeaway for this explainer is this absolute asymmetry. If management successfully repairs the balance sheet, stabilizes core operations, and cleanly resolves the Nasdaq issues, today's tiny equity value could eventually look like an incredible once-in-a-decade bargain. But on the flip side, if they face more losses, get backed into forced financing, and succumb to their listing problems, existing shareholders could lose most, if not all, of their capital. This is an extreme special situation that requires strict position sizing and an iron stomach for loss tolerance. The multi-million-dollar question remains, will they manage to engineer a miraculous balance sheet repair, or is this destined to end in total loss?